Well, hey there, it's Terry Sawchuk. It is Friday, so that means that it's time for 4-Minute Friday. Sorry, we had to wait a day just to collect some additional information. I wanted to be a little bit more prepared for this week's conversation. So this is kind of important. As you can see on this chart, the S&P 500 has really started to decline a little bit, but it's still two things. One, it's still in the upward channel, and two, we're still above this blue blob here, okay? And that's going to probably act as support, but it might not hold, okay? And then if you look at the NASDAQ is a little different. The NASDAQ has definitely fallen a little bit more. It's touching this area of support. We'll see where it closes today. I would tell you that, this down here, this is I guess a bearish indicator here. And certainly the big drop in this indicator is suggesting that potentially the momentum has shifted a little bit. And obviously after a few days of big sell-offs, that would make sense. I don't know where the bottom is on this short-term drop. I would tell you that in the big picture, if we want to look at, what are some of the drivers of this, I would say first and foremost, the failed assassination attempt on Donald Trump changed the complexion a little bit. Number one, it just shows you how messed up our society is right now in our political environment. But two, I think the chances of a Trump presidency have gone up exponentially. It's pretty clear that Biden does not look like he's going to be the candidate. I don't know how they're going to move the chess pieces around on the Democratic side of things. He looked like he was their best chance. I mean, there's some rumors that maybe, they'll replace Biden with, it could be Newsom, Whitmer, although those names, I'm hearing Whitmer more as a vice presidential candidate. And there's a couple of larger names like Michelle Obama, which, by the way, I don't think that's a likely scenario at all, but we'll get into why. I don't think it is. So it's unlikely that, the Democrats are going to field a candidate that looks better than Biden, at least not right now. And the problem, I guess, for the markets is that the markets are trying to reassess what a Trump presidency would look like. And I would make the argument that, we're probably going to continue to take on debt. It should mean generally lower interest rates, but that doesn't necessarily mean that the lower interest rates are going to come at the longer end, like the 10, 20, 30-year treasuries. That's why in our portfolio, we did make some changes with the Fed likely going to cut rates. You can see that, the short end of the curve, so 2 years, 5 years, maybe as much as 10 years, those are likely to have peaked out and dropped down. If you look at the 10-year, okay, it bottomed somewhere down here at around 4.15-ish. Now it's bounced a little bit, but you can see that the trend is still downward for now. And I think that that's probably, it'll either stabilize. It might push back up into this area a little bit, but I don't think rates are going to go, at least at the 10-year and below, a whole lot higher. So where that puts us from an investment strategy standpoint today is that we're looking at this pullback on the equity side of things and trying to determine whether this is just a short-term blip where you buy the dip or whether it's going to turn into something more meaningful. I suspect right now that I don't think the Democrats are throwing in the towel on the presidency at all. I think they're making it look like they are. But they're rolling up their sleeves and trying to figure out who gives them the best chance. And I think as long as they believe that they have a chance at the presidency, then both Janet Yellen and Jay Powell are probably going to play along. They're going to do everything they can to support their cause. And likely they will. And again, this is another aspect of things that gets a little bit convoluted, but it's important. I think there's a growing chance that we could see a rate cut in July. At the next Fed meeting, which is coming up pretty soon. So we'll see how the markets respond to that. Obviously, crypto has gone crazy because Trump came out in his speech last night and said that he's very pro-crypto and they're not going to do a CBDC and he's going to keep Elizabeth Warren and her goons away from crypto. So that obviously pushed that part of the market up quite a bit. We'll see if that lasts. Again, we don't do crypto. It's just an observation, really just about where the state of affairs are right now. So I would say we're pretty neutral right now. We expected a bit of a dip, but we're getting one. I don't know how meaningful this is going to be. And at this point, it's not causing us to make any changes to the models other than just to pay a little bit more attention, or not that maybe any more than we already do, but certainly pay attention and wait for things to play out a little bit. There's a big options expiry today. So when that's gone, it'll open the door next week for maybe a change in tone. So I don't think this is going to be a catastrophic decline at all. In fact, it's probably, if I had to guess, more of a buy the dip scenario. But there are some things out there that could take this a little deeper. So in the meantime, our clients are positioned really well. We made some adjustments in our advisory portfolios. We added gold. We added some short-term treasuries. So I think we're positioned well for the change in interest rates. All of our equity strategies, by and large, are hedged. So even if this dip continues a little bit further, it's not really going to have a meaningful impact on the majority of our equity portfolios. So I like where we're at. We'll just have to stay tuned. But I would tell you, going forward, I think between now and November, chaos is going to be more likely than less. And I'm not sure that we've seen anything yet. So with that, have a great weekend, and I will see you next week, and we'll be back for 3 Minute Thursday.